This to me is going to be the biggest credit event of our lives, and it's just getting started. And the bottom line is the Fed is still hiking. So I look at people saying they're getting bullish copper. I'm like, okay, well, good luck. Fed's still hiking. China is still tilting over, and there's have a major shift there. And then you look in the macro. Okay, that's a problem because they mess with their best customers. They have complete lack of confidence internally, and for good reason. And then you look over at Europe. What's the entire continent of Europe? The PMIs are all negative, below 50, and they're still hiking rates. So this is what you'd expect, I think, in the tail end, the biggest liquidity pump in history that's still dumping, and this is early days. So yes, I've been early, but a few months from now, this should get ugly.
Treasury Secretary Janet Yellen said she's increasingly confident that the U.S. will be able to contain inflation without major damage to the job market, hailing data showing a steady slowdown in inflation and a fresh influx of job seekers. "I am feeling very good about that prediction," Yellen said Sunday, when asked about her previous hopes that the U.S. would avoid a recession while still reading in consumer price gains. "I think you'd have to say we're on a path that looks exactly like that." Speaking in an interview on her aircraft en route back from attending the Group of 20 summit in New Delhi, the Treasury chief also played down any risk from China's efforts to increase the sway from the separate BRICS grouping of major emerging nations. "The G20 remains the premier forum for global cooperation," she said. For their part, Goldman Sachs Group Incorporated economists now see just a 15% chance the U.S. will slide into recession, down from 20% previously. Positive signs for the U.S. have contrasted with disappointing data from China that have suggested the world's number 2 economy may not reach Beijing's target of 5% growth this year. Mike McGlone shares his view on the comment by Yellen, stating that this is going to be the biggest credit event and whatever is being shown to the public is not as it is. Let us now dive into the video as Mike McGlone shares his macroeconomic concerns. Feel free to hit the like button, subscribe, and drop your comments below.
The thing I can bring to the table right now this morning is we just got off our macro meeting and it keeps tilting. We have all our major people in BI who don't have positions. That's a cool thing. What I do, I've been both buy side, sell side, trader, non-trader, is I'm not really allowed to trade. So we have very open views. And so Anna Wong says, we're going to have a recession by the end of the year. Yes, we're delayed. Expect negative retail sales this week and expect deflationary forces just to start getting started. That's cars and rent. Our equity strategist says the stock market's consolidating, and we get that. Pointed out that the Fed's unlikely to cut rates. Ira Jersey, our mortgage strategist, said we have record low mortgage affordability index, and then our equity, our FX strategist said that we need a dovish adjustment for the Fed for the dollar to stop. So what I like to add to that is I see overwhelming forces now on top of risk assets. And Dave said it, I don't see any chance for the Fed to pivot away from this. They have an 800-pound gorilla on top of the market. And that is, if you just look at the baby step, the next key meeting is not September, but November, is there's a 40% chance they're still going to hike rates. The key question is what takes that away? Maybe they don't hike. The bottom line is risk assets going down will take that away. Maybe, but as Dave said, unless there's a credit event, there won't. But the best way to have a credit event is just have a lower tide. So I look at this as the key thing in the macro is this is all, what's the best leading indicator on the planet? What's it doing again on this Monday morning? Bitcoin is right near, if you close here, where it was this morning, it's going to be the lowest since June. And I completely believe that I'm probably going to write about it, partly because there's still disputes, but there's no other asset I've ever seen that doesn't close down and trades all the time. And it's the best performer ever during a most historic event ever when we had zero interest rates. So I like to tilt over to, I'm getting a lot of people pushing back in my call for crude oil. I'm still very bearish crude oil. I like to point out, well, here's a good bear market. The average price this year is the same as 2007. Like, okay, well, why should I be excited about that? So here's a good bull market. The average price for gold is the highest ever. Well, okay, well, I guess I can get excited about that. Give me a reason for that to change. So in the macro, I see what's happening here is epic historic. I mean, we all know that, and I'm looking at this. Look at it for 10 years from now. What's happening is just look at CPI is going to be the story this week. It's going to come out around 3.6 or so. It's right 3.2. Core is going to be 4%. Means the Fed can't cut because it's their rate, their target's 2%. But if you look back the last time they started cutting during in 2007, right before the financial crisis, CPI peaked at 5.6%. It's much lower. It's almost half that now at running 3%. Yet they started cutting rates. Why? Because as Dave mentioned, there was a credit event kicking in. I can see crude oil doing it, going back to it was before COVID, around $40. I can see S&P 500 going back to around 3,000. Yes, those are far away from now, but in a normal recession, with the Fed still tightening, it's never happened. Okay, what's probably going to happen? And what's the fastest horse in the race? Why shouldn't Bitcoin do the same? So yes, I know the macro. So one thing also is the most widely known, assumed, accepted trade in the history I've ever seen of markets is, yes, it's bullish for Bitcoin when all these ETFs launch. And then I always go back to Benjamin Disraeli. What we anticipate seldom happens.
With U.S. markets homing in on this week's critical August inflation update, Japan threw a curveball into the piece by signaling a possible early end to its easy money stance, just as other G7 central banks are mulling to end their tightening. In a weekend interview, Bank of Japan Governor Kazuo Oda said the central bank could end its 7-year-old negative interest rate policy when achievement of its 2% inflation target is in sight, suggesting the BOJ is considering official interest rate hikes as well as an early end its bond-buying yield cap policy. Mike McGlone continues with his bearish outlook for the general economy, adding that everything would go back to their low levels before we see a correction. Let us now continue with the video.
I'm not just bearish. I'm bearish all risk assets. I mean, literally all of them, because of what's happened historically. I'm saying 10 years from now, if hopefully I'm alive, or 100 years from now, how are we going to view this period in history? And that is, most people who've been trading Bitcoin and cryptos for 10 years don't realize how historic it was. Zero interest rates, negative interest rates in Europe, still in Japan. I mean, it's global, and that's changed, flip of the dime, particularly leading in the largest countries. So I want to start with this, 2.5x. I'll give you that statistic. That is the 2-year note yield in US, how much it is higher than the average of the weighted average of the top 3 other countries combined: China, Japan, and Germany. Now I said weighted because Japan's a bit distortion because it's so low, but if you take Japan, China, and Germany, their total GDP is about the same as US. Yet our rates are 2.5 times higher. That is an accident that's breaking already. And you're going to see every day that goes by, you're going to see scrambling to do something about it. Like we saw this morning, China's trying to do something, Japan's trying to do something to help support their currencies. It's the force is overwhelming. It's not going, you can't do anything about it. To me, that's what's breaking in the short term. So the key thing is you got to get the monkey, the 800-pound gorilla off the back of all risk assets, and that's the Fed. And I just look at baby steps at a time until you at least see the first sign that they're not going to hike at the next meeting. They might start cutting. And if they cut the first time they do cut, which is not going to happen,
that's the crash.
It takes 2 years. So this is how different and how unusual this is. So if this doesn't happen the way I think it's going to, I'm so happy to have to write those textbooks and I'll look like, yeah, I was completely wrong, all those lessons. But this is where we rope in the minor things like this morning, you look at Ethereum down almost 2%. Well, that's just the day. You look at compared to Friday, they're down lower because we only have one day here. But that's where the macro is so overwhelming, so significant. And that's one thing I do enjoy when people say, I've been doing this for 20 years. Like, you have to have been doing at least for 30 or 40 years and have experienced bear markets, because 20 years means 2003. That was the best time ever to buy, because what happened was in the back of a very bad bear market that collapsed, massive liquidity, and boom, it's time to buy. And then we had the crisis during 2007, 8, 9, massive liquidity. I just keep looking at markets rolling over, still rolling over. The Fed's still hiking. That's not that complicated. Turn off CNBC, 2-year notes at 5%. Thank you very much. See you in 2 years. I think I'm at least ahead of the game on is trying to predict when markets start showing divergent strength or weakness. And I completely agree with Dave. I have for a while that Bitcoin is going to trade more like risk-off asset treasuries and gold. But the signs are it's not. It's still actually doing the opposite until I start seeing signs of that. Again, this morning, it might take a while. And that's why I'm worried it's going to have to get really low and cheap before it starts doing that. And everything, I think, it's going to have to get low and cheap before people realize, okay, this asset, which is unstoppable, unlimited demand and unlimited demand, decreasing supply, it's gonna at least show those signs of strength. Show me the beef first. And that's, again, I just look at it on a 2-year basis. It's down 30-something%, and the stock market's basically unchanged. It's like, come on, it's down. Okay, Bitcoin's down 42%. S&P is unchanged on a 2-year basis. On a 1-year basis, same. It's still underperforming. You have to risk adjust that. So typically, Bitcoin used to be 10x the volatility of the stock market. Now it's like 2 to 3x, depending on which index you're looking at. It should outperform on the way up and outperform on the way down. It's underperforming on the way up, and it's still outperforming on the way down. At least show me signs of that divergent strength. It's not doing it yet. Maybe when the ETFs are launched, but it's a known. We all know it's coming.
Germany faces a recession in its vast industrial sector and a lackluster performance in exports, both of which have significant impacts on the whole of the economy. In its report, the Commission pointed to manufacturing weakness and said Germany was hit particularly hard by energy price shocks linked to the war in Ukraine. The European Central Bank's efforts to tame inflation via interest rate hikes also contributed to the slowdown in the Eurozone, the report added, days before the ECB meets to decide whether to raise borrowing costs again or pause its campaign. The International Monetary Fund had already predicted Germany would be the only major advanced economy to shrink in 2023. Growth in the Eurozone and the European Union as a whole will continue, but will be lower than predicted earlier this year. In May, the Commission said the Eurozone would grow by 1.1% in 2023, but revised that on Monday to 0.8%. While we avoided a recession last winter, the multiple headwinds facing the EU economy this year have led to somewhat weaker growth momentum than we projected in the spring, the Economy Commissioner Paolo Gentiloni said during a press conference. The Commission in its report said there would be slowing economic activity in the summer and months ahead, with continued weakness in industry and fading momentum in services, despite a strong tourism season in many parts of Europe. Europe will also not be able to count on strong support from exports amid weak global growth and demand. What do you think of McGlone's forecast of the economy? Let us know your thoughts in the comment section below. Also, don't forget to give us that thumbs up, subscribe, and turn on notifications. Thanks for watching.